Most people move through life believing money behaves exactly as they see it in their daily routines. They use it, earn it, save it, and hope it will help them move forward. But hidden beneath the surface, there is a structure far older and far more powerful than the money people hold in their hands. It is a structure built on quiet rules, slow movements, and currents that run through every economy in the world. It shapes the rise of countries, the choices of governments, and the direction of global markets. This structure is not a conspiracy in the dramatic sense. It is something more subtle. It is a system built on interest, and its influence has grown so deeply into modern economies that most people cannot even see it anymore. When you begin to understand how it works, a strange realization appears. The map of global power is not drawn only by armies, resources, or technology. It is shaped by the mathematics of time and the pressure created when interest grows faster than nations can manage. To understand how this began, you must go back to a world where money was still a simple tool, not a global force. Early societies exchanged goods through trade, and debt appeared only when one person needed temporary help. There were no complex contracts, no multi-layered systems, and no institutional structures behind the loan. It was human, direct, and limited. But over time, rulers and wealthy families noticed something about lending. They noticed that lending did not simply solve problems. It created influence. If a person owed you, decisions could shift in your favor. If a village owed you, you held a kind of power that did not require a crown or a throne. This discovery set the earliest foundation of an interest-based system. Once interest appeared, the relationship between lender and borrower changed forever. A small additional payment for time turned into a new form of leverage, and that leverage followed societies as they evolved. As trade expanded and early kingdoms grew, money began to move faster. Merchants traveled longer distances, rulers needed large amounts of wealth for construction and defense, and cities expanded beyond the resources they had. Lending became the fuel for ambition, and interest became the cost of that ambition. Many rulers tried to control the growth of the system, but they faced the same problem every generation faced. People needed money quickly, and the fastest way to get it was to borrow. As borrowing increased, interest grew, and the structure became stronger with every transaction. This was the birth of something that would eventually transform into a global mechanism. The turning point came when early banking families discovered how powerful repeated lending could be. They realized that money did not need to sleep inside vaults. It could move, circulate, and return multiplied through interest. These early lenders were not controlling nations directly. They were simply following the flow of opportunity. But without realizing it, they were building the architecture for a world where interest would shape the direction of economies more than rulers themselves. As centuries passed, kingdoms became nations, trade became global, and governments began to borrow on a scale never seen before. Interest moved from small transactions into the heart of national decision-making. When a nation borrowed, it did so with the expectation of growth. But interest did not wait for growth. It grew on its own quietly and steadily. This shifted the balance of power. Governments that once acted freely suddenly had to plan around repayment schedules, revenue projections, and the constant pressure of obligations. Decisions about roads, ports, armies, and social programs were influenced by the invisible timeline of rising liabilities. What began as a simple tool for convenience slowly became a central force shaping the future of entire populations. The more the world connected through trade, the stronger this system became. When one nation borrowed, it influenced its currency. When many nations borrowed, it influenced global markets. Financial centers grew into powerful institutions because they held the ability to shift money across borders with a single decision. These centers were not acting with malicious intent. They were simply part of a machine that had been growing for centuries. The machine rewarded lending, multiplied interest, and pushed borrowers into long cycles of repayment. Every major empire faced this dynamic. Some managed it through growth and discipline. Others collapsed under the pressure. By the time the modern era arrived, interest was no longer a side element of finance. It had become the backbone of global economies. Nations funded infrastructure, wars, expansions, and even daily operations through borrowing. Corporations borrowed to grow. Households borrowed to progress. Interest flowed upward through these layers, shaping society through quiet but constant pressure. The structure had reached a point where no country was fully outside it. Some were deeper in the system than others, but all were connected. This is where the mystery becomes clear. How did a simple idea grow into a global force that influences nations more than almost any other financial factor? The answer lies in the next part of the story, where the rise of modern banking, the shift in monetary structures, and the compounding effect of time created a system that grew faster than anyone predicted. As the modern age unfolded, money evolved from a physical commodity into an abstract measurement of value. Gold and silver were once the anchors that limited how much wealth a nation could expand. When those anchors weakened, a new kind of money emerged, one that depended not on metal, but on confidence and credit. This change did not happen overnight. It unfolded through decades of experimentation, crises, and adjustments. But once the transition was complete, interest gained a level of influence that earlier societies could never have imagined. It no longer measured only the cost of borrowing. It became a mechanism that multiplied itself through layers of lending, creating entire economies built on the expectation that tomorrow would always be larger than today. The rise of central institutions accelerated this shift. These institutions were created to stabilize economies, regulate money supply, and support national financial health. But their ability to expand or contract money introduced a new dynamic. When money could be created through lending, the system began to reward borrowing more than saving. Instead of waiting for resources to accumulate, governments, corporations, and households could bring future income into the present through loans. This created waves of growth, but it also created long chains of repayment that stretched far into the future. Each link in the chain carried interest, and each layer of interest pushed the system into deeper dependency on continuous expansion. Financial markets responded to this environment in predictable ways. Investors saw lending not only as a low-risk activity, but as a pathway to steady returns. Bonds became the quiet backbone of governments. Loans became the fuel of corporations. Mortgages became the foundation of household wealth building. The system had fully shifted into a world where money grew most effectively through interest-based structures. This was not inherently harmful, but it created a cycle where stability depended on constant motion. The moment the motion slowed, pressure increased. When pressure increased, borrowing became more difficult. When borrowing slowed, growth slowed. And when growth slowed, the burden of interest grew heavier for everyone. This dynamic became clear during economic downturns. Every major slowdown revealed the same pattern. Borrowing surged in good times, interest obligations accumulated quietly, and when the economy cooled, repayment became a challenge. Businesses reduced operations, families cut spending, governments faced revenue shortfalls. Yet the interest on past borrowing continued to rise with perfect precision. It did not adjust to market conditions. It did not pause during recessions. It did not soften when people struggled. It followed its own mathematical path, unaffected by human circumstances. This is why financial shocks often turn into cascading effects. When one part of the system weakens, it spreads pressure to other parts. A household struggling with payments affects lenders. Lenders adjust their models, which affects businesses. Businesses reduce investment, which affects employment. Nations attempt to stimulate activity, which increases borrowing. The cycle repeats each time, faster and more complex than before. The hidden engine beneath all of this is the same: the steady accumulation of interest that does not stop moving. As global trade expanded, the influence of this engine crossed borders. Nations became interconnected through borrowing and lending. Some countries lent, others borrowed, but all were woven into the same fabric. When one nation faced trouble, those connected to it felt the ripple. This interconnected web made the system more efficient, but also more fragile. A financial shock in one region could travel around the world in moments. Interest obligations tied to global lending moved through currencies, markets, and governments, creating a pressure that no single nation fully controlled. The fault lines became visible during periods of severe crisis. Economies slowed, markets panicked, and governments injected enormous amounts of support to prevent collapse. Yet even in these moments, the deepest issue remained untouched. The structure continued to rely on expansion, and interest continued to grow regardless of the real economy's ability to support it. Policymakers tried adjustments, regulations, stimulus packages, and restructuring plans. Some helped temporarily. Others created new problems, but none addressed the core mechanism that kept the system under pressure. Modern households feel this pressure in a very personal way. The rising cost of living, the long duration of obligations, and the slow erosion of income power all trace back to the same structure. When interest multiplies through every stage of borrowing, the burden spreads quietly across society. People work harder, yet progress feels slower. Companies expand, yet margins tighten. Governments promise relief, yet obligations continue to rise. The cycle does not come from visible decisions. It comes from the silent mathematics shaping the background of every financial choice. This leads to the moment today where many nations carry larger obligations than ever before. The global system is more complicated, more interconnected, and more dependent on borrowing than at any point in history. The hidden interest mechanism that began centuries ago has now become the foundation of the modern economy. It influences how nations invest, how markets behave, and how people live. And as the story moves into the present day, a powerful question emerges. What happens when a system built on rising obligations reaches a point where growth can no longer keep up? The answer becomes clearer when you look at the breaking points that appear repeatedly across history. These breaking points reveal the same pattern, the same cause, and the same consequences. They show how economies respond when the pressure of obligations becomes heavier than the ability to meet them. And in that pattern, the truth of this hidden system becomes unavoidable. It is strange how every era believes it has finally mastered the mistakes of the past. In the late 20th century, central banks around the world were confident that mathematical formulas, advanced forecasting models, and highly trained economists could tame the cycles that had tormented previous generations. But the global economy was already drifting toward another turning point. Debt had seeped into every corner of daily life. Mortgages, credit cards, auto loans, student loans, and corporate borrowing had become so common that people stopped seeing them as risks and began seeing them as normal. That shift in mindset was the quiet victory of the hidden interest system. When something becomes normal, it becomes invisible. And when it becomes invisible, it becomes powerful. A single event exposed that power more clearly than anything else. When the housing bubble collapsed in the late 2000s, millions of families discovered how fragile their world truly was. Mortgages that had felt manageable became impossible. Jobs that had seemed secure vanished almost overnight. Entire neighborhoods saw homes emptied, savings erased, and futures rewritten. Behind the scenes, the interest machine kept turning. Loans that had been packaged and resold continued generating payments for financial institutions, even while the original borrowers were sinking. It was a moment when the public realized that the system did not slow down when people suffered. It accelerated. The aftermath revealed something deeper. Governments stepped in to rescue institutions whose collapse would have crushed entire economies. But the rescue did not erase the structure that had created the disaster in the first place. It strengthened it. Debt poured in to stabilize markets and restart activity, yet that same debt became the foundation of new obligations. Every solution created a new layer of interest, a new set of long-term promises, and a new future cost waiting quietly to be paid. People believed the storm had passed, but the pressure inside the system only increased. As the years moved forward, the pattern repeated. Public debt reached levels once considered unthinkable. Household borrowing climbed higher than the peaks seen before the last crisis. Corporations expanded using funds that were cheap to access but expensive to maintain. Central banks kept interest rates low, hoping to encourage growth. But low rates allowed more borrowing, and more borrowing fed the machine again. It was not a cycle anymore. It was a spiral. The global events of the early 2020s exposed the system again. Economies shut down. Supply chains froze, and governments rushed to protect citizens. The fastest way to act was the easiest way to act. More debt. Trillions were created, distributed, and absorbed into financial networks. Once again, the world was saved by borrowing, but the price of that rescue was deferred into the future. And once again, interest waited patiently for its moment. It always does. People often think the system is controlled by a single group or a single nation. But the truth is far more unsettling. It is controlled by the mathematics of compounding. No individual can change it alone. No government can simply step outside it. Economies depend on credit. Credit depends on interest, and interest depends on continued expansion. If growth slows, pressure rises. If debt becomes too heavy, the structure trembles. And if nations attempt to escape by borrowing more, they tighten the very chains they hope to loosen. That is the silent trap few ever see. But the most surprising part is how quietly history repeats. Ancient empires collapsed under debt long before modern banking existed. Medieval kingdoms saw citizens flee into forests to escape obligations they could no longer meet. Entire civilizations suffered when the cost of maintaining borrowed wealth exceeded the strength of their economies. The names change, the currencies change, the methods change, but the pattern stays the same. Debt grows faster than the ability to repay, and interest slowly consumes the future. Today, the world faces a moment that feels familiar. Nations hold record levels of public debt. Companies rely on continuous refinancing to survive. Families live one emergency away from collapse. And financial institutions design products whose complexity hides dangers that even experts struggle to understand. Yet everything continues because the system depends on momentum. As long as people borrow, as long as governments issue bonds, as long as institutions lend, the machine runs. But when the machine slows, the pressure becomes impossible to ignore. The question that rises now is the same question people asked centuries ago. What happens when the cost of maintaining the system becomes greater than the benefit it provides? Some argue that innovation will save the world. Others believe regulation will restore balance. Many hope growth will naturally resume and push the dangers further into the distance. But hope does not erase mathematics. Compounding does not answer to optimism. It only answers to time. There are three clear lessons hidden in this long and complicated story. The first is that debt is never free, even when it looks harmless. Every borrowed dollar carries a future cost, and that cost grows quietly whether people notice it or not. The second is that interest reshapes societies in slow and subtle ways. It influences how nations make decisions, how governments design policies, and how individuals plan their lives even when they believe they are acting independently. The third is that cycles do not disappear. They simply shift to new forms. What looks stable today may already be carrying the seeds of tomorrow's instability. The world stands at a delicate point where the weight of past choices presses against the uncertainty of the future. No one knows exactly what the next chapter will bring, but one thing is clear. The hidden interest system is not a distant force. It is a living presence inside every paycheck, every bill, every national budget, and every financial headline. And understanding it is not just a matter of curiosity. It is a matter of preparation. If you found this journey valuable and want to explore more hidden forces shaping global economies, make sure you subscribe, stay connected, and continue learning. The next story begins where this one ends, and the next question may reveal more than any answer ever could.